He will kickstart with a presentation, and after which there is a survey that was done among the DFIs on the continent on this element of currency risks, why we do not hedge it, and most of us have alternative ways of hedging them, and therefore what is available to us will be given on this presentation. Mr. Rood. Yeah, you can do that.
Can you hear me? Thank you. Thank you very much for having me. I just had a quite unique experience when we were taking the photograph, because as a past middle-aged, gray-haired white male, I am normally a problem for diversity. And when taking the picture for the first time, I realized I was of added value. So why is this relevant for today's meeting? I think it is because what I see is that, let's say, when we're discussing African economic development, it is a matter of Africans, and I think this is a very positive thing to see. And then there are the partnerships within and outside Africa, and we have the opportunity and the responsibility to help and to challenge each other and to support each other. But ultimately, I believe when looking at this room, this is the way it's supposed to be. So for that reason, I'm extra honored to be here with you and to share our experience in currency risk management and to offer support for those that think they can use support in their risk management. So just for your background, I also have had the honor as part of my professional history to work as a board member or investment committee member of institutions in Mauritania, Côte d'Ivoire, Nigeria, Senegal. So apart from having, let's say, the outside-in perspective, I've had the immense pleasure to also learn, let's say, the inside-out perspective of managing financial institutions in Africa and supporting to economic growth. But to start with, if I can have the first slide with, please. It's always a bit of a question. Do you know who actually was a recipient of the first development loan of the World Bank Group? Just as a quiz. Indeed, sorry. Yes, that was actually the French government. And, well, there actually, if the slide would be there, you see the letter of the French ambassador writing to the World Bank. Could you please provide us with a loan of $500 million US dollars? And as things go, already in 1946 in development finance, they received a loan of $250 million, so roughly half of what they asked for. But I think more importantly for today's topic, they received a loan in US dollar. And that, ladies and gentlemen, is where the design flaw in the fabric of development finance started with the very first loan. Because of course the government of France had its tax income in French francs. And by saying yes to these $250 million US dollars, the French government immediately had a huge mismatch in its balance sheet. And if we look at balance sheet management, it's not only about governments, but it's also about households. We've seen it in Poland, in Hungary, where people went for loans in Swiss francs as a mortgage loan to buy a house because the interest rates on the Swiss franc were so low. But there's nothing like a free lunch. The interest rates on Swiss francs were so low because there was a huge risk reflected in those risks, and that is the risk of appreciation. And indeed, the Swiss franc appreciated 20% vis-à-vis all European currencies. So those people stuck with a mortgage suddenly faced an extreme increase, not only in their payments, but also in their debt. People were forced to sell their homes, so the price of the asset went down, the price of the debt went up, and that is how we create crisis. We create crisis ourselves by having a mismatch between assets and liabilities. And whether it's a household or a company or a financial institution or a government, it's all exactly the same. The basics of balance sheets management are about preventing mismatches. And therefore, actually, Steve, I was very happy to hear that currently AADFI is focusing on improving and supporting the institutions with increasing their balance sheet management. I think a stable, resilient, crisis-resilient development finance institution is the start of a resilient economy and financial sector. Now, there's also something else about people accepting dollar loans or euro loans versus their local currency. I mean, the reality, even today in Ghana, even though quite extreme, the so-called risk-free interest rate just went to 19% versus an equivalent in dollar of roughly 3%. So you'd say anyone with basic education see, okay, 3%, 19%, which one is more expensive? It looks pretty obvious. There's a difference of 16%. That differential, that interest rate differential, is there for a reason. And the simple reason is inflation. So going back to university, there is interest rate parity over the long term, regardless whether it's 3% or 19%, it all evens out. So over the long term, pretty much any loan, regardless in which country you're based, is as expensive as its dollar or euro equivalent. The key challenge is a local currency loan is simply the right product for a local currency earner. So if ever one of your clients says he prefers to have the dollars, euros, yen, pounds, whatever, because the interest rates are lower, from my perspective, it's part of your responsibility to educate your client that the only reason why it seems cheaper is that there is a hidden speculation in the difference between the two interest rates. Now the question for you is, of course, would you like to build a portfolio with clients that are engaged in construction, infrastructure, etc., or would you like to build a portfolio with clients that are based on currency speculation? Well, now I'm not totally objective, but as a development financier, I think the answer seems pretty straightforward. And what we see in the world of development finance is actually that the vast majority of the clients, infrastructure, housing, hospitals, roads, are all local currency earners. There's this small fraction of exporting companies that actually generate US dollars that would actually need or could use a dollar loan. And that does not only go, let's say, for African lenders. I've seen it also in the institution I worked for, FMO, the Dutch Development Bank. There is a need and a pressure to grow in Africa because Africa is the reason why most of these development finance institutions exist. So there is a pressure to push loans. And I've seen my own institution when I was still working there, handing out a 50 million loan to a bank in Tanzania. And those were focused, those loans, for exporting microfinance and SMEs. I mean, there are not that many. So I know the development finance institutions are also part of the problem because they also have a pressure to build volumes and to hand out loans, and sometimes it's simply the wrong product. Now I would like to really a brief introduction on T6, why we exist, and well, let's say how we ensure that we do not go bankrupt when we get all the Forex risk in our books. So the next slide, please. So the problem I just sketched about the mismatch between asset liability, so the mismatch between your hard currency funding and your local currency earning clients, is a problem that all development finance institutions in the world have. So these, let's say, the top part are the shareholders, the bottom part are the governments that have invested in the fund. Now, if you look without a, you will see all the familiar names in the world of development finance. The reason why they joined forces in TCX is that they realize they all have the same problem. They should stop offloading currency risk to the clients they want to support. Because the mission of all these institutions is pretty much similar. They want to create economic stability, leading to economic growth generating jobs, fighting poverty, and building a green economy. Now the thing is, the moment they start lending to you in hard currency, the generation of stability is ruined. They offload instability and volatility to you. So from that perspective, I also believe you can also push back to the lenders with whom you are at the table when they offer large-scale hard currency loans. Because, let me tell you, they know it is the wrong product. They joined forces in TCX for a simple reason, and that is one of the two pillars of the business model of the fund. Pillar one is diversification. So currently, we have roughly 60 currencies, exposure to 60 emerging market currencies, about 1/3 in Africa. And the reason why diversification works is, let's assume there's a crisis in the Ukraine and neighboring countries, then the fund gets hit there, but in the meantime, things are pretty much okay in Central America or East Asia. When there's a debt crisis somewhere else, let's assume in Africa, by then the former Soviet states will be okay. So we get hit geographically, but the fact that we have a global diversification allows us to continue to be a stable partner for our counterparties like you. Actually, the second leg of the business model is that we use local base rates in terms of interest rates. So the pricing we offer for your currencies is priced off the yield curve of the government T-bills and T-bonds. And actually, to the fact that we are offshore, in most cases, somewhat below the government yield curve, but Demba will explain more to you about that. So, by actually joining forces, all our shareholders have created a risk pool called TCX that as a joint risk pool offers a much better risk return than if any of these parties would do it on their own. So it's a pure rational economic choice in the case of currency risk to pool as many risks as possible in one entity, and that entity are we. The governments are there supporting, well, mainly for the same reason that they have invested in African Development Bank, World Bank, etc. So they think none of the emerging market-based borrowers should be facing currency risk because it's contrary to the mission of development finance. Lastly, and by far in the future, our biggest partner, the European Commission, it's growing extremely fast in the world of development finance. So this instrument called EFSD, in the next one of 5 strategic priorities is to increase the level of lending in development finance. And I think you will see more and more as well. The European Commission is becoming a strategic player in development finance with focus on Africa. Next slide, please, for the introduction. So this is also my last slide. 4 key principles. 1, reliability. We are made to withstand crisis. So the good thing was the fund started in 2007. So in the world, we're a young player in the world of development finance. We got a good stress test immediately during the global financial crisis. That's the one we withstood. After that, of course, we had the commodity crisis, the first ruble crisis, euro crisis, recently COVID, and currently Ukraine. So the model is tested, and we're always there. That is our purpose in life. 2, additionality, meaning that we do not compete with commercial institutions. I think in terms of the opportunities to hedge currency risk, a number of African countries have possibilities for 6 months, 12 months, up to 18 months. But after that, the market becomes quite thin and unreliable. In principle, we start at 2 years and we stop at 30 years, offering local currency rates. And as I said, pricing off the existing curves in your market. So the data we receive from your market is our starting point. Third, that is the market-based pricing as I just entered. Oh, the previous one, please. And lastly, no speculation. Logically, a core one to our purpose. So for every transaction that we hedge, we know there is a real underlying loan to a financial institution, to an infrastructure project, or actually to a government. We recently started moving to offer our services also to governments, closing the first hedge with the government of Uzbekistan, because as we all know, in reality, the balance sheet of the government is a huge challenge for the stability of an economy as a whole. Now, if we then look at today, already briefly mentioned by previous speakers and Steve, we're in between a rock and a hard place today. So from a global economic perspective, yeah, I hate to be the bringer of doom and gloom, but there is some of it actually around. Just came out of COVID. We're moving into the effects of the invasion of Ukraine. So we see energy prices rising. Majority of African countries are importers. We see food prices rising. Majority of African countries are importers. We see the dollar strengthening and dollar interest rates going up. The majority of the African countries are borrowers, so they are exposed to this risk. And at the same time, we see that the current relatively high levels of indebtedness are debts in US dollars. So there is a very significant economic challenge coming your way. This is not doom and gloom, this is just a reality. And I think the thing for all of us as development finance institutions is that we have been set up to face this reality, and more so, we are actually set up to be counter-cyclical. So the larger the crisis, the more important we become. And that means pretty straightforward that in the coming years, your work, your impact, your institution will gain significantly in importance for the stability of your countries and for the creations of jobs in your societies. So there's one way to look at a crisis that is terrible. There's also another way to look at a crisis as a time to stand up and do what we've all been set up for as institutions and as development bankers. So I'd say never waste a good crisis, but ensure that your institutions are crisis resilient and that they can play the role that is expected of you. And I think in today's world, currency risk is one of the key factors. And from that perspective, we're actually super happy and honored to be with you, to share what we can do, to share the lessons learned from previous crises, and looking forward to a great session with you. I'd now like to hand over to Isabel. She will actually present the outcome of the survey done between your members, and thank you very much for your attention.
I think TCS did a survey among the AADFI members, as well as the World Federation of Development Institutions, and to find out whether we need local currency funding and also whether we have access to hedging instruments. So she will present the outcome of the survey, and it will launch into the solutions that are available. Isabella.
Thank you, Steve. Thank you to the chairman, the board, the Secretariat General, and all the members of AADFI for having us today. I'm particularly happy to be back. I lived in Ghana a few years ago, so it's like coming back home for a second time, so thank you for the opportunity. I will present you the survey that we did with AADFI, thanks to the Secretariat, to all the members, and the result of their point of view on the local currency risk. It was the fruit of several sessions. We first did several sessions of training with AADFI members, and after that we asked the member of your teams what they thought were the issue on currency risk, exposure, and all that. And I would be glad to hear your feedback based on what your team have told us. So thank you for the, can we see the first slide? I can already start by saying that we sent it to all the 80 plus members of AADFI. We had an answer from 22%, around 18 members replied all over Africa, and it was a quite balance between North, West, East, and Central Africa. And what came is that 60%, is not appearing, 60% of the respondents mentioned that they had currency exposure, and 80% mentioned that they would like to hedge, but they didn't have any access to hedging, and one of the main impediments for them for not hedging was the perceived cost of hedging or the fact that they were using natural hedge. That was the key takeaway. So I already passed the first slide, so you can move away. Yeah, after that. So next one. So we're going to go do a deep dive into the survey. So these were the respondents. So you can see that he is, as I mentioned, was well spread all over Africa. Next slide. And then we went to a deep dive of the balance sheet and asked about lending activities and funding activities. And what we see that is that most of the lending activities, more than 94%, is in their functional currency, so domestic currency. So you can see that most of the lending is done in local currency, which makes total sense. And when we look at the funding activities, which is the next slide, see that around 84% of the funding comes in domestic currency. So there was the next slide. Right, so yes. So between 94% and 83%, then you see that already in the balance sheet actually of the different banks, there is a mismatch on the balance sheet side. Can continue? Next one. And then we went to look at the source of funding. Where do you get your funding from? Assuming that most of the funding come from deposit and onshore, so 68% come from domestic currency and 32% come from offshore, so long-term funding that you had from external sources. And we assume somehow that these external funding come in hard currency. And when you look at also at the mix between the funding activities and the lending activities, you see that most of your assets are, the lending portfolio of the banks is 75 to 90% of the total asset, but the funding activities coming from the liabilities are only 50%. So on top of the currency mismatch, there is a funding gap mismatch, and because this funding probably comes from international lender, that increase your currency mismatch because you need to fund from long-term funding from international lender. And we ascertained that when we ask to international lender to give you fund, it should be in local currency to kind of have a better control of this balance sheet mismatch. So, yeah, can go to the next, so can go further. And so that was the first point, so on the balance sheet side. And then the second point that was seen is from the member, the respondent, is that they see that there is an exposure, a currency exposure. 61% see there's a currency exposure. And then after that, we'll ask them, now that you have a currency exposure, what type of framework do you have in place to manage this FX exposure? Next slide, please. And that's what we see, that most of them have a FX policy in place, strategy, framework that they use. So that's already a very, very good number. So there is the good perception of the exposure of the risk and already framework infrastructure in place to be able to manage that. And then next slide. And when we look at the financial management solution, risk management solution that they're using, it's a great mix of natural hedge, which is what it's always the easiest and at best to do if it's possible, and then other different solution, reserve account, when you put a bit of your money on the side, on the capital to be able to absorb the shock, which is usually not the best solution of capital optimization. Some people use insurance. We don't know, I think it's more in North Africa, buy insurance in a way to cover the currency risk. And some on land in hard currency, so it's kind of transferring the risk to the customer, which is not the best solution. And finally, most of them don't have a FX solution. So all the solutions, most of them, except natural hedge, are suboptimal solution to manage the currency risk in your balance sheet and the funding that you receive in hard currency. Next slide. So when we ask, do you have access to a risk management solution? Only 7 banks mentioned that they have access to currency risk solution, offshore or onshore. So it's a very small amount. So they show there is a lack of product accessible in the local market. And next slide. But so it shows that most of the banks have ethnic policy. So you have the infrastructure in place, at least the basic of the infrastructure in place. You have policy in place. You have the team in place, kind of looking at that issue. But you don't necessarily always have the right product to manage what are your FX exposure. And when we ask if the banks were interested in hedging, so it's a resounding yes. 78% are interested in hedging. The main reason for not hedging are the perceived cost and the lack of availability of the solution. So you can skip the next slide and go to the second next. You can go. So what are the solutions? You have currency mismatch in your balance sheet. At least that's what your teams are telling us. You have a funding gap. You are much more efficient in lending, so you at least fulfill your purpose on lending locally, but the funding side is a bit of a struggle. So I think the theme of today in resource mobilization is really key, seems to be key to all the challenges that have been shown in the survey. There is a strong interest in risk management policy and framework and solution, but there is a lack of access. How to solve this lack of access? There are hedging providers like TCX, and that's why we would like to show you what TCX has been doing in collaboration with AADFI, as part of training with your members also, but as part of what kind of product solution we can offer you to better manage your balance sheet and funding. As Rod was mentioning, you can receive local currency funding from the DFI, international DFI. They are our shareholders. They can do it. You can push back and ask us to do so, or at least propose to show you the 2 offers, and it will be the best way for you to balance your currency mismatch. But also, if you have issue in your balance sheet, do not hesitate to talk to us, but more particularly to Demba, who's going to be the lead of this training, and is our structure in chief in Africa, and the best to solve your problems. Thank you very much.
Mr. Tembe, much as the solutions going to be highlighted are more foreign exchange based, we also acknowledge the fact that we also have interest rate risks on our books. But this will concentrate only on the exchange rate side of solutions. And but in the past, I think the last 2 sessions we've had, there has been extensive training on foreign exchange for most of the staff of the DFIs who attend our balance sheet management solutions. So Tembe will tell us what solutions we have, and we can look at them and begin to ask ourselves questions as to what do we need and how do we approach TCX for solutions. Tembe.
Thank you very much, Ruud and Isabel, for this introduction. So we are a team, so we can all of you reach us when needed. So thank you very much for having us. Akwaba, as we always say here in the country, bienvenue, welcome, marahaba. We can speak in the different language within the continent, but my skills are quite limited to 4 now. So it's a pleasure to be here and to present into more details how to tackle this issue that have been introduced by my 2 colleagues when it comes to FX risk, especially funding coming from international lenders who mainly use dollars, euros. We mentioned during the introduction session SDR, which is mainly dollars, euros, Chinese yuan, Great Britain pounds, and Japanese yen, to remind. So I think we may have around for 30 minutes just of presentation to go into more details. So if you can go on the next slide, please, to present what I want to discuss with you, what I want to present with you today. And please do not hesitate to interrupt me to ask questions, and David also, please feel free. So as explained by Ruud and Isabel, so for us it's a no-brainer when a borrower earns revenues in local currency. Just for an asset and liability management, the debt the borrower he will use or her will use to fund its activity need to be in local currency. And here we can see where local currency can be needed in different sectors, different areas. And I'm sure all of you guys are familiar with these sectors because you are active in the agriculture space by providing funding. I'm thinking, for example, about Agricultural Development Bank here in Ghana, but not only. You are active in the infrastructure space, mainly energy, off-grid, on-grid. You are active also within the financial institution, providing funding to commercial banks, to MFIs, which need funding to run their activity. But the list can be very large and wide, sorry. And of course, the local corporates who may need funding to finance their activity. And one element that has been mentioned by Ruud, which is crucial here when it comes to a role at TCX to provide FX solutions, it's the additionality. Of course, if I take the example of the non-exporting corporate, if they come to us, to you, or to us as a DFI, for searching funding to finance their activity, it's mainly for one main reason: the lack of capital they cannot find within the commercial and financial space. So they come to DFIs and ask for funding. So, of course, financing their activity in the right currency, for me and for us, is a good approach. So just in terms of area in terms of sectors, the players are very huge here. So if you go to the next slide, please. I wanted here just to ask one question. So what could be the situation of an African DFI? But not only African DFI, but we can implement this situation to the Latin America, to the Asian continent, where we are also active at TCX. So if you are an African DFI, which is active in the country at a national level, or you are a DFI active at a regional level, and I'm sure we have both type of institution here in the room, and you want to finance sustainable activities, like, as I mentioned, within the different sectors, within the different areas, and you want to finance it in local currency, but there might be some restrictions, some limitation in accessing funding in local currency. So mainly, this is mainly related for many reasons. It can be a limitation to the local market because there is no more liquidity for the DFIs at national or regional level to to obtain funding and to finance their activity in local currency. And I'm sure a lot of us DFIs might be in one of these situations. Some of you maybe have access to local currency funding, others not. And we may have a third portion of DFIs being in the middle of those two situations. So if you go to the next slide, the main question regarding financing activity in local currency is the crucial and key element, which is how can I get funding in local currency? I wanted here just to highlight two sources of local currency. The main one and the obvious one is the domestic market, the onshore, what we call the onshore source. So you can get local currency if, for example, if you have a license from the central banks to collect deposit. Some of you have access to such funding and others not. You can also have access to funding in local currency through the commercial banks if they are ready to provide funding on a, for example, term deposit of 1 to 3 years maximum. Of course, there is also some others more innovative source of local currency funding. If I can take the example of debt capital market, let's take an example, for example, in the UEMOA zone, the Francophone, the France CFA zone, where some actors like the Caisse de refinancement régional de l'habitat, which is the mortgage company, who can issue bond to the local market, get the funding there, and provide it to the financial sector. In some markets, there is no deep debt capital market to allow such operations. And last but not least, but it is also very limited in some cases, the local currency on the onshore basis can come from the central bank's refinancing windows. It's mainly on a short-term basis. If I took the example of the main central banks, mainly on 1 week or 1 day liquidity assistance. And of course, we mentioned a lot of innovative solutions that have been introduced during the introduction session by Mr. Salomon Kreiner, which is, for example, this solution to enhance the credit of the DFIs to be able to issue bond into the capital market. That can be done through, for example, thanks to Guaranco, but not only. AADFI can do this, and other DFIs active in the region. So we can see there is a lot of solution to access local currency funding on the onshore basis. There is a second alternative, which is offshore international fund. So we may face two situations. The first one is, okay, I get dollars, I get euros, and I provide loans in local currency. As a banker, I will not do this, because if you ask to your ILM team officers or risk management, of course, you will run some mismatch in between your asset and the liabilities. So this is the first way to obtain funding from offshore source. You convert the dollars into local currency and you on-lend it on the domestic market. And the fourth way I wanted to highlight here, and where TCX can have a role to play, is still getting funding in dollars or in euros or in any other hard currencies from international lenders, investors, DFIs, multilateral development banks, and hedge these loans, this funding, and convert it from hard currency into local currency by using one single product. We will have more detail on it, which is derivative solutions, cross-currency swap, FX forward. We usually provide at TCX. So if we go to the next slide, as I mentioned, when you use derivative, you may face two solutions. The first one, I always call it the golden way, the simplest way, because it is very simple and straightforward. Just receive funding in local currency. As I mentioned earlier, you may face some limitation in accessing such funding, which can be very short-term on the onshore basis. But if it goes to offshore, if you talk to the DFIs, Ruud mentions in this nice chart where we can find all the usual suspect names, AFDB, Agence Française de Développement, KfW, World Bank, African Development Banks, etc. DBSA, which is present here. You can obtain funding from them in local currency, but not only in dollars. So if you discuss with them, you have several options. And our key role at TCX, or key mandate, so my key task within the structuring and sales team is to let know the borrower that they may have option on the table. If you are discussing funding from these DFIs, local currency need to be an option just to finance the activity you want to support in your domestic or regional markets. And it is very easy to obtain because it is a loan, standard loan, with a nominal and an interest. So nothing changed with the usual way to do business with those lenders. There is a second alternative. I will still use the way I usually present it. I will call it the silver way, but it is still a good way to tackle this issue of local currency, which is more tailor-made because here you will have the keys of the cars to drive the strategy, to implement it. When I say having the keys, I mean directly hedge yourself by using derivative. In the golden way I mentioned, you have only the loan denominated in local currency. In this second situation, you have still the loan, and you do whatever you want to hedge your exposure. If you want to hedge just a portion of the loan, you can do it. If you want to hedge just a portion of the interest you will receive from this loan, you can do it. So you can do whatever you want for your own need. So that's why I call it the tailor-made situation. And of course, by doing this, you will face a hedge provider, which can be TCX or others intermediaries. If you go to the next slide, and to go into more detail on the two different solutions I just introduced to you, the first one is receiving a funding denominated in local currency from offshore lenders. As I mentioned, very standard, very straightforward solution, a loan, principal, and interest, which is quite simple, and the way you usually received funding from abroad entities. So here I take an example of Rwanda. We can implement it in the different currencies we operate. As mentioned by Ruud, we are active in Africa in more than, we have around 60 currencies actually in the book, and a third of these currencies are in Africa. So Rwanda can be an example, but we can just take the same figures. Of course, interest rate pricing will change, but the rationale will be the same. If you use XOF, if you use Tanzanian shilling, if you use Botswana pula or Ariari Malgache, so just to give you some currencies. Here I take the example of a fictive situation, but it can be real. Let's take this example from Rwanda, where a DFI is discussing, the Rwandan DFI is discussing with an international lenders to fund their own activity on a long-term basis. Usual way to do this kind of negotiation, people discuss and reach an agreement in terms of impact, of course, the use of fund, the notional, and of course, last but not least, it is very important, the pricing. So after the two parties negotiate, they agreed on the following here. I took the example of the way you can receive funding in local currency to match your asset is, in this example, a 50 billion Rwandan franc denominated loan, which is equivalent to, just to make it simple, 50 million US dollar, long term, to be additional 7-year with 2-year grace period, so something very usual. And the Rwandan DFIs agreed to pay 9%. And interest rate and repayment on this loan will be business as usual, semi-annual. We can do it quarterly if needed. And last but not least, because when the international lender provide loan denominated in Rwandan franc, and if the functional currency of these international lenders is dollar, these lenders need to hedge himself or herself. So that's why the lenders will require a return in dollars. And the way to do it is very simple. We can see it on the next slide with some diagram. You have the three-party. The first one is the African DFI, in my example, the Rwandan one, who receive funding in Rwandan franc. And you have the international lender, that can be a DFI providing funding. And of course, in this situation, I call the golden way, the international lender pays TCX to contract the derivative directly. So I think if you can just go to the next slide, there is a missing information on the right. I don't know if it will appear or not. Konate? Okay, please, again. Again. So just to make it more quickly. So I can comment at the same time. So in this way, the way it works, it's very simple. So the African DFIs still receive funding in local currency and pay 9% on top of the notional, and the international lender enter in a cross-currency swap where the lender will receive 9% in terms of interest. Sorry, will pay 9% of interest in Rwandan franc, and in the opposite side receive 2% in dollars. So it is a very simple way in describing how it's works. If you can go to the next slide, please. So the solution number 2, I call the silver way, but it is mainly the tailor-made one. If you as a DFI want to receive, to still receive funding in dollars, because you can issue bond into the international capital market, you can receive euro, dollars from the international lenders, and you say, okay, I'm sufficiently robust with all the treasury function I have, with my people on the ground to tackle this issue. I can myself transact directly with TCX in order to hedge the FX exposure. So I wanted here just to explain you in four steps how it's worked. So you are a regional DFI, you have access to US dollar funding, and just for the example, we assume that you are paying 3.5% in terms of interest rate to the international investor/lenders. Step 2, you are in a situation you have dollar in your books. You receive funding in dollars. You invest. You put it in your liquidity portfolio, but you have an interest from one of your borrower, one of your clients, to fund its activity. I took the example here of Tanzanian shilling, but as I mentioned earlier, you can replicate it with all the other currencies. And you are in a situation, as I explained earlier, that you have no access to local currency. You have just dollars in your books. So you decide to invest in this company in Tanzania, in which you think that there is impact in terms of development or any other sector I mentioned earlier, which require funding in local currency. But we will not stop at the steps 3, because if you do this, we will stay at the solution where you use your dollars, you convert it in Tanzanian shilling, and you on-lend it to the borrower. But to close the exposure you are making in your balance sheet, you will need to enter into a cross-currency swap and to close this exposure. And it is easily done. It can be easily done with TCX or any other intermediaries or finance hedge providers. And to do this, it's very simple, because you just need to have all the documentation required to transact cross-currency swaps. So mainly, I don't know if Some of you are familiar with the ISDA contract and the collateral associated to this, but we can see it later. But it is a standard documentation you need to sign before entering such derivative solutions. So in this example, we can see how many regional DFI, which is active in different countries, who have mainly dollars in its liabilities and in its liquidity portfolio, how such a DFI can still provide funding to the clients in the right currencies, in this case, Tanzanian shilling. And it is always nice to have some picture on the next slide to see how it's worked with some flows. Of course, at the end of this session, we'll share with you the presentation to go into more detail if needed, but I want to just to have this chart here to explain how it's worked. Is, as I explained earlier, we have the different scenario where, in this example, the African DFI, which is at the center of this diagram, transact with TCX on the left-hand side, go to the spot market, sell the dollars, receive the Tanzanian shilling, invest it on the local market, and still hedging itself and making good return, which make the life easier for the African DFI to pursue business on a positive side. So I took two scenarios. In this one, I don't know if it's very clear, but I mentioned unhedged margin. And the reason why I wanted to highlight in this scenario that the margin is not hedged is just to make you aware that, as I mentioned earlier, it is a tailor-made solution. In this scenario, I took the example of just paying to TCX, in this example, 11.5% in terms of interest for getting funding in Tanzanian shilling, and at the same time providing a loan still in Tanzanian shilling, but at a higher interest rate, because you need to make a net interest margin, in this example, of 6.5. So at the end of the day, you pay 11.5% to the hedge provider, and you receive 18% on the loan side, making this 6.5 net interest margin differential. So you can decide to unhedge it for different reasons, because you have some budget, some charge in the local, in the country if you have some presence on the ground. But you can also decide to fully hedge the margin and make the return in dollars. That's what you can see on the next slide, where I presented the mechanism with a hedged margin. So same situation, only numbers change. In this scenario, you pay 18% of interest rate to TCX. The same interest you are receiving from the borrowers. So you pay 18, you receive 18, so you have 0. But knowing that in a swap you have two legs, so you are paying 18 to TCX, and TCX will pay you back 9%. Just to give you some numbers and example in terms of interest in dollars. So at the end of the day, you have dollars in your books, you provided funding to a client in Tanzanian shilling, and you have protected this borrower and yourself by entering into a cross-currency swap with TCX and still making a net interest margin of 6% in this example. Business as usual, still, and the business can continue if there is no accident, of course, on the underlying side or on the derivative side. So I'm sure some of you may have reaction when I spoke about pricing. I took the example of Rwanda, Tanzania. 9% for the hedging in Rwanda, 11.5 in Tanzania. And as mentioned by Ruth and Isabel, each currencies have its own interest rates for many reasons. We can debate a lot on why Rwanda is pricing at 9 versus 3% in dollar, why Tanzanian shilling is at 11.5 versus 3%. Those figures are not precise because things are moving every day. If I give you an example of Ghana, just spoke about it during the introduction, something around 19%. So depending on the maturity, it can be 20. But on the pricing side, we can explain for which reason. On the next slide, please. So when we talk about local currency funding, usually the 9% example in Rwandan franc I took, or the 11.5 in Tanzanian shilling, is just an equivalent of two components. The first one on the right-hand side is the base rate. In my example, dollars like 3%, plus the expected annual average of depreciation of the currencies, 6% in the case of the Rwandan example, 9 minus 3. And of course, we at TCX, we are trying, and we hope that we are doing the right choice by putting numbers in that area when it comes to FX risk, that we are doing the right thing. And the history, as mentioned by Ruud, still give us the right answer is we are doing the good choice, and we hope that we can still continue to improve if needed. But what I wanted to just to highlight here is when people see interest rate in local currency in a frontier or emerging market, and they see the high interest rate environment, it's mainly related to the inflation associated to the currencies, and that can be reflected into the pricing. So on the next slide, after saying some words on how interest rates are can be different from one currencies to other compared to euros, even though Japanese yen, which is, for example, close to 0%. The historical path of the different currency show you that maybe you can tell them by you just take some currencies where there is depreciation. Of course, there is some appreciation, but I want to just to highlight here some trend. For example, Rwandan franc, to continue the example, with an annual depreciation per annum of around 5%. The numbers are limited to 2020, so if we go to up to date today, probably it will be higher than this level because, as mentioned, we all know that the pandemic, but not only the Ukrainian war, have impacted a lot of currencies. If I take the example of Egypt, so during the last months, I understand that 80% of the some commodities in Egypt came from Ukraine, and the Egyptian pounds have been depreciated for 15%, knowing that the central banks was pegging the currencies to dollars. So the pressure coming from outside, external factors, impact directly the trend. So I wanted to show you on the next slide the different parameters which can explain, and of course we can have a long debate on why currency are moving in that way. But I think, Konate, you need to put the button several times to have all the parameters. Thank you. But I will not go into all these parameters. Just I want to just to highlight the fact that there is a lot of parameters that influence the currency. On the next slide, as mentioned by Ruud, we use market data to build our own pricing. So we always look at the existent data you can find locally, and if not, we do our own model and try to put numbers on that risk. On next slide, I wanted to just to show you how we categorize the different currencies from the more developed market to the less developed one. Of course, no surprise, South Africa with Morocco actually, have one of the more developed markets in the African region, so that's why there is a liquid market. And coming back to the additionality point mentioned by Ruud earlier, we only act where there is no market. So in main situation, if one of you want to access to ZAR hedging, there is actually a market. If not, you still come to TCX. For example, if you may face some restriction in terms of tenors. And of course, we have some other currencies like Ghana cedi, which is a partially based market. On the next slide, just wanted to show you how pricing evolved. Just look at the red line. This is the fixed interest rate pricing versus dollar leg. So it gives you the cost of hedge. Ghana, you can see it is close to 20%. France CFA zone, the XOF, something around 4.7. Madagascar, something around 8 to 9. But I took these three examples just to mention, to show you how pricing changed over the time. Ghana, it is a partially market-based pricing method. CFA zone, it is pegged to the euros as we know, but pricing changed depending on the sentiment. And the hike, you can see it's mainly related to the speech that has been announced around the France CFA reform, and all the market reacted badly on the way that they are expecting potentially a potential move on that side. And last but not least, Madagascar is, I wanted to highlight this example because the market is very limited, so we are on the fourth category, but we still can propose pricing on that side. Slide 4. Which one? Yes, Konate, please. Yes. So it's a way just to categorize the levels. For example, how we construct our pricing in Ghana. You have a derivative market in Ghana up to probably 18 months, 2 years, depending on the timing. Actually, it's very short because markets have some pressure. So we use the pricing. Yesterday, I was talking with some commercial banks here in Accra, and I was asking them, okay, what is the sentiment following the recent Bank of Ghana hike in interest rates? I will not say a word, but it gives you an answer that situation is going on can be very difficult, but the pricing they are showing in some hedging instruments can be quite high. Recently, we saw 3 months pricing at 30%, and sometimes 60%. So we are definitely in a situation where sentiment can be complicated, but we always look at this pricing, do our own assessment, put numbers on the tenors. So if we go to the slide on page 25, I just showed you how pricing evolved during the time, but as mentioned also by Ruud, how the pricing is depending on the tenors, because when we talk about long-term funding, we are more across the curve, and the orange line is the TCX price based on maturity. For example, Botswana, if you want to receive a funding from an international lenders on a 7-year tenors, we are exactly at the same level where the local government bond issue debt into the capital market. And if you go lower in the Botswana case, the pricing is higher than the bond market. If you go on the long tenor, where you may have a role to play for additionality reason for long-term funding need, TCX pricing is below the government curve. So this is very interesting example just to highlight that borrowing in local currency on an absolute level is high for just numbers. It can be single or 2 digits. But if, for example, you are active into the public space in Botswana and you have a good cost of funding, providing a loan in local currency to a public entity in Botswana can be favorable because you can tell to the borrower that the cost of funding is close to what your own government is paying on its local debt. Rwanda, 3% differentials between the government bond and TCX pricing. Kenya, opposite, but I wanted just to give the different spectrum, and I hope that it will come back below after the election where it creates some volatility. Just to go to the next slide, and because I think we are running out of time, Isabel usually always tell me, Demba, please go fast. David, you are still okay?
Tamba, just hold on. These tend to be a little bit technical for a number of us. So as Tamba goes on, you can interject. If you have any questions specifically relating to a country situation as to what can be done or how we should go about things, I would suggest that you start asking the questions at this time so that you know that there are opportunities for you in your country to hedge. So, Temba, you can go on, but if there are any questions as you go on, yes?
I think I see 2 hands.
Yeah, let's start with the gentleman behind the NIB chairman.
I don't know if there is a mic who can supply.
Thank you very much for the presentation. But I think in your presentation, I saw 2 things.
Yeah.
I saw where you mentioned that investor can give local funding to institutions. Is that possible?
Sorry,
Like
can you please repeat?
Investors can give local funding to institutions. Like, I don't know if KFW will give like a ZOP funding to like EBID, for example. I don't think that is possible. So I don't know if that slide, I mistook it. Number 2, most of us are DFIs. We are supposed to give concessional funding to our partners. With a rate of 18%, we are creating a credit risk event. And I don't think any partner want to go with you at that rate. So for us, me thinking about this, is that a solution that I would want? Because at 18%, nobody will touch me. Even I'm struggling to give somebody at 10%, 8%. So if I'm going to hedge my fund, going to hedge, end of the day, it's going to create problem for me rather than solution. So I don't know if this is the way we should go at a DFI. A commercial bank, yeah, that makes sense. A commercial bank, I mean, with the rate of what's going on, you can give it 18% or more. But for a DFI, it's counterproductive. So I don't know if you guys are going to provide solution tailored for DFIs specifically rather than a one-size-fits-all for everybody. So I think it's very important that DFI, because absolutely I'm saying this cannot work for me. You know, sitting here cannot work for me. So I think it's very important that you look at it, go back, look at what can work for DFIs, so that at the end of the day, it can be a solution. Because most of us are doing natural hedging, which will transfer the risk to the customer, which is not really a good solution, but that's the best we could do because, again, I cannot lend more than max 10%, for example, which is the best I could go. So I think that's very important. Thank you.
Thank you. I don't know how we can you take all the question. Okay. Just one point, in which country are you operating?
We're operating across West Africa.
Sorry?
Across West Africa.
Across South Africa. Okay, thank you.
Okay, thank you for the opportunity, Steve. I just want to find out, you said even if I have secured a facility already, and then I need to make, let's say, biannual repayments, we could still discuss with you where you can support and help us to hedge the exchange risk on our balance sheet. Is that it? I just want that clarity.
Yes.
Okay. Thank you very much. This discussion, I believe, explains why the BSD team take very seriously the mismatches on the balance sheet of commercial banks. And I think after here we will see you. I'm here with my deputy finance. We have a challenge we would like to discuss with you. My gentleman has not been hit, so he may not understand what it means. Thank you very much.
Okay. On the, I think,
I have a question, please.
okay.
Thank you. I want to ask if all the currencies are eligible in the TCX solutions, or is it only limited to a certain portfolio of currencies, or all countries can be covered? Thank you.
Well, let's give it a try. So that's a question. Globally, we offer in about 120 currencies. In Africa, I think all but 4 or 5. So any currency that has a functioning central bank and that is not in a state of, let's say, war, we offer. We offer also Burundi. Name a country, and the harder it is, the more we enjoy finding a solution, actually. Which also brings me back to the second question of the gentleman, what in an 18% interest rate environment? So there's two possible economic environments where hedging does not work. One of them is when there is a transfer or convertibility problem. So what we had for a couple of years in Nigeria, when the local institutions are flooded with local currency, but they just cannot access the dollars to repay the loan. Then the swap matures, the debt is still there, and our product fails, actually, because our product should protect you against currency risk. When there's no conversion, no access to dollars, it does not work. It's exactly for that reason that we're in the process to set up a product jointly with MIGA, where they take transfer and convertibility risk and we the full currency risk. So that's one moment, the hedge doesn't work. The second, it does work, but it becomes economically impossible. When the local base rate is above, let's say, the 15%, you basically see entities stop borrowing. They go to their families, friends, etc. for smaller loans. Larger investments get postponed. But a high double-digit interest rate is just killing any economy. Now, I understand that you say we need a loan at max 10%, but I think it's also good to realize that if the reality prices a currency at 15 to 20% and you lend at 10, you're no longer in the business of lending. You're handing out grants that are disguised as a loan. Because if the reality is 20% and you lend at 10%, you are just distributing free cash. And that will kill your business model, and it would also kill our business model. So, and that's also where the political angle comes in. Whenever banks are being bashed for high interest rates, whereas the interest rate environment is such that the risks have to be reflected in high interest rates, the political solution is not forcing loans down, because that's another way to either hand out grants or to kill your financial system. And I think it's up to us that just don't fight reality. If the reality is a high interest rate, that's the reality we have to deal with. And it hurts tremendously at the level of medium-sized enterprises and companies. But ultimately, it's up to the governments, the Ministry of Finance, to create the stable entities and environment that will be reflected later on in a lower interest rate. It's not up to you to hand out grants.
I think there is a question.
So just a few slides back, we talked about the unhedged margins.
Okay, I want to understand that, you see, DFIs are not competing with banks. And that's one thing that is clear. We're not DFIs are not meant to compete with banks. They are meant to support, if possible. DFIs support government a lot, and then probably some few institutions. And there's no way, again, I'm going to mention this. I've been here in the business, I've been a commercial banker for roughly 2 decades before I went to development bank. I know the difference now. Now, in development banking, most time people come for concessionary funding. What that means is that they're coming to you because they had no other options. They've done with the banks, they couldn't. Because again, we're going to create credit risk. events for these guys because they looked at the whole double-digit interest rate they couldn't afford, and they said, okay, no, the best way to go is to go to DFIs. Now you come to DFIs, you're getting the same funding. I mean, you're punishing everybody. At the end of the day, the mandate of DFI is for developmental purpose. It won't work because, again, we're putting pressure on these guys that are coming to us. Government today, we have a lot of galloping inflation everywhere. We have exchange rate we're talking about going. They can't deal with it. Their public funding is in a mess. What they can do is look at constitutional fund that can help them. So what I'm saying is that you guys can go back. Look at products specifically for DFIs. End of the day, so that it could distinguish between, I don't want to be looking at this and say, hey, I'm here wasting my time, because at the end of the day, it won't work for me. I'm an institution. So would that be a thing for me to say I'm benefiting? No, I'm not. So what I'm asking is that, because it's a DFI institutional forum, there are also DFI here that also have the same challenges. Can we look at products? Because at the end of the day, to KFW, I'm looking at how to get consumer funding from them or go to other. So how those kind of rates that are, like I said, 3% without having to give me extra cost to it, they go in there. I'm also going to look at covering my FS risk and at the same time covering my credit risk. That kind of increase my cost as well. So I'm not looking at just one side to the story, right? The other side that we haven't spoken about that will come into play, and I'm not looking at 18%, I'm looking at probably 25%. And that for me, it's not no for me for a DFI. Commercial bank, yes. But for me, it can work. So that's very, very important that I want to challenge you. Go back, create a product that will fit DFIs, and then we can present that, we can sit down to see if this works for us. Because I cannot see going something at the end of the day. It creates an operational issues for me as an institution, and then I'm priced out. So that's what I'm trying to say. So I understand what you're saying, very clear, but for DFI, it doesn't make sense to really look at this the way it is. Thank you.
Maybe just answering before to leaving, because I think you have a question. Thank you very much for the question. And we, during last year, have made this these basic remarks where pricing simply do not work. There's a lot of currencies, a lot of countries where you just use how the market-based approach, which is the one we use at TCX. You've got fundamentals, put a numbers, we can be wrong or right, but we put a number. And at the end, you do transaction or not. If you don't, it can be probably related to the pricing, because pricing is the key driver at the end. Last year, we designed, thanks to the European Commission, just to give names, a program to decrease pricing in some region. Central Africa was part of it. The XAF entities, so Cameroon, Gabon, Chad, Equatorial Guinea, and sixth one I forget, but on the within the six countries within the XAF region, we made it. DRC was part of the solution. Madagascar also. I think there was around 20 currencies where we faced this situation. And thanks to the support of the European Commission, we created this program to decrease pricing, just to give you numbers, for 2 to 3%. It can be small or high, but we do agree that in some circumstances, pricing do not work. And we always are trying to look at solutions to tackle this issue. And I will not tell you about the future because the discussion is still around the table, but we hope that in the coming months next year, we can support more transaction. I'm looking at the same time, this is the key man who decide. But we hope that there will be some solutions to tackle this issue. But at the end of the day, I always say there is no free lunch. There is always a pricing somewhere, and someone needs to absorb it. Maybe it can be through grants, different solutions, and I know that some of DFIs, because I was working for Agence Française de Développement before joining TCX, a DFI active in France. They have solutions to decrease pricing. They have solutions to provide subsidized and constitutional fundings. there is a lot of solution around the table, but everyone is using its different tool, and at TCX we are just trying to mobilize it and deliver the best service at the best price. But I do agree that there is still some job to do on some specific situations.
You want to? Yeah, just before you go.
Yes, no, I just want to make a comment on the pricing. I understand that a lot of DFIs have concessional financing. But when you look at the 3% versus the 18%, is the reality of the market before concessionality. So when you have after they'll give you 1% instead of 3, it's a 2% difference. It looks bigger because it's 1 to 3, but then you'll have 2% equivalent on the 18%. You will still be below the curve. The danger is when you have too much constitutionality is that you start perceiving the constitutionality as the reality of your market. And that's something that I think is important to pay attention to that. And as Dana was saying, there is no free lunch. So we can provide constitutionality, AFDB can provide constitutionality, but at the end of the day, you have to know the reality of your market, because when there is no constitutionality on other loans, someone is paying for it. If it's you at 10%, then it means that you are paying for it, or your ministry, because someone somewhere is going to have to cover this currency risk. So if it's not you, it's the central bank, and at the end of the day, it's the system.
I'd like to say that before we go to the next questions, that you engage TCX because they are customized solutions as well. There's a need to sit down and have a chat around your pool of currencies and see what solution can be tailored for you. Because in this forum, we're talking to everybody, and I don't think it's one size fits all. So the issue is more the principles, and then you can approach and have a dialogue and see what can be cut out for you. The next set of questions, please. Yeah.
So, Teva, thank you. This is a very good presentation. And yeah, the discussion around local currency, as the client solutions for DFIs are just, it's good to have it, primary today as part of the discussion. Two questions I had. You've partially answered a few of them now with some of the responses. Nothing as a free lunch. Again, market, on the hedge, on hedge margins, yeah? And you mentioned if accidents don't happen, and I think we cracked up around it, what are the chances, based on your experience, of the accidents? It turns out that the solutions for the accidents were the next slides, because that's what interests me, and that's why I'll come to you, because of the accidents. So just give me some scenarios of that. Number two, I saw that the spectrum of the markets, from being the selected, from developed markets to the least developed markets, and I think again lots of the challenges are around the least developed markets that are not developed. What do you use as proxies for these markets that do not have a curve, government curve? What do you use as proxies for them? So, I don't know, Liberia, for instance. Thank you.
Okay, we'll answer to the last first and go back to the first one. Where there is no market, like Madagascar or Mauritania, I'm from Mauritania, there is no financial market, but we can't put a price on it. As I showed on one of the slides, there's 4 categories of currencies. The last one, where there is no market, we use an internal model to put all the parameters needed to end up with a number. And by parameters, we look at several input, like the GDP growth, the inflation.
I don't have a market. So
Exactly. So we have our internal model. So we do not disclose all the elements. So it's where how you go to Coca-Cola and ask them how you do this famous drink. They will say, just test it. But of course, we are transparent, and one thing that has been presented by Ruud also is transparency and reliability, is to explain reason for which we are at X%. Last discussion I have in Burundi with someone was saying, okay guys, why do you pricing at 20%? My cost of fund in Burundi was discussing with commercial banks was 8%. Yeah. It's mainly related to, I know that you have a lot of remarks, but I will let you just in a few seconds. Our own assessments lead us to say that the currency is over-evaluated. So at the end, we are assessing if a currency is over-evaluated or sub-evaluated. So depending on where you stand, the pricing can be high or low, or below or higher above the government curves. And as I mentioned in some slides, you can see some of our pricing are below the curve. Rwanda, for example, for many reasons. Government bonds on a 10-year are around 12%. We are at 9%. There is a reason for which can be related to the fact that there is structural issue on the market. Probably the banks have a good presence on the ground, and they can provide funding by investing this bond at that price. So banks can have power on that side. If the market is more, let's say, concurrential, having more investors, not only banks active in these currencies, they can create more transparency about the pricing. So at the end, we will deliver the maximum information, but not...
Demba, maybe it's good to add that we don't set the pricing.
Yes, so just to add an important point, how is the pricing? We don't communicate on that, but we work with an external company called OGR Research, former central banker, IMF. They use an inflation-based model, and they're the one that define the pricing. Once we have that pricing that they use based on a model, we have a pricing committee talking about the governance that is independent from us. They have experts in the derivative market. They fix the price. We do not. So it's a mix of central bank inflation using a model and being validated by professionals in the market. We do not define that. And another important point about TCX, we are not a profit maximizing entity. We are an impact maximizing entity. We don't make profit. That's not the purpose in life.
And I'm very sorry that the question came out the wrong way. The idea, my idea behind this question, the rationale is not to determine the pricing, was to understand the metrics in the perception of these markets, because these markets are opaque. Hence, you have to, the pricing is a reflection of the risk that you perceive in the market. So the idea of asking about the transparency around the parameters is to help me understand the reality of the markets that you talked about, that, that is being kind of hedged also by, the concessional loans that we talked about. So that's the idea around the transparency, so that we as lenders or borrowers that are coming to you for these solutions kind of understand how our markets that do not have the relevant data are perceived. So it's not to kind of delve into your business.
No, I understand. But if you have interest in TCX, let's transact with us, and we'll invite you in Amsterdam, having a 1-week dissemination within the team.
Thank you, that's it.
And just answer to your first question, accident. By accident, you mean default on the loan? Okay. If there is a default, so you have no more asset, no more loan on, as an underlying to hedge, so you need to terminate the hedging, because no asset, and you maintain the hedging, so you will create volatility with the valuation of the hedging instrument. So usually, investor lenders just early terminate the hedge, and of course, when you early terminate an insurance product, you can probably pay a fee or win a fee, because depending on how pricing works, it can be positive.
I think there was a hand up here. Okay, all right, I think you continue.
Yeah, how many minutes do we have?
We have less than 15 minutes.
15 minutes? Very good, yeah, Rose.
One addition on, let's say, the unwind in case of a default or a prepayment. So what you normally see with commercial entities, specifically in illiquid markets, there's a huge bid-offer spread. So since we are not a for-profit or profit-maximizing entity, we price on the mid. So we engage with you in the mid, and we also unwind on the mid. So there is, let's say, not a loss of value between 1 and 10% because of this bid-offer spread. So we're actually quite nice to you.
I think we can, Konate, go to the presentation on page 26.
I think there is a question here.
Ah, sorry.
Yeah.
Konate, can you please fill back? On which slide? 14 or 15, probably. Feedback. Okay.
You mentioned LC-dominated facility. Request LC-dominated long-term funding when negotiating with international lenders. Mm-hmm. Now, my question becomes, can I go to like maybe KFW or Agent Français and say, give me loan in ZOF? I have dealt with them, I'm not sure they will. So I don't understand, that's the place I don't understand. So after I'm asking, if there's something like that, for me, that's the best hedge I'll have. I'll transfer the cost to them and say, you know what, give me ZOF. I have my partner that want to take a loan in ZOF or in CDs. I can ask for CDs, but I don't know if that is done. So that's where my first question was that how does this work? But this for DFIs with the best solution for DFIs, because I'll definitely go to them knowing fully well that I can get the best, I'll naturally hedge the fund, and they will take the cost of the fund because they are giving me the currency that matches my request. So that's why I'm asking that. I don't understand that part. Maybe you could explain a little further on that.
The answer before giving you the mic is simply yes. It's possible. So that's why I say the golden ways and the easiest way, you need funding not in dollars, not in euros, but in XAF. Yes, they can, and they are doing it. So I encourage you every time. Okay, maybe you can have a parallel discussion, and we'll connect you with the good people, because all these institutions, the key message, one thing I want to demonstrate here and to keep in mind is all these investors have the technical capacity to offer you funding in dollars, euros, and
on to that point on local currency lending. I'm from AFD. Do local currency lending. Not in all markets, so it depends on what currency you want. So just to say that it is possible, but not in all markets. We have a list of approved currencies. I don't know them off the top of my head. Thank you.
For FDB, there is a list of 14 currencies. You can do Rwanda, Kenya, Uganda, not Morocco, I know, South Africa and others, Nigeria, Kenyan shilling. Zambia is the last example. So for different investors, they may have some restriction in some currencies. We took the example of the African Development Banks. They cannot do all the currencies, but they can do some. You mentioned my former company, Agence Française de Développement. They can do all the currencies, excluding XOF. For main reason, France is guaranteeing the parity. So there is a lot of internal issue that may explain the reason for which one lenders, not only the international but African, can provide funding in other currencies.
Are there any other questions before Temba wraps up? Any other questions?
If not, I think we can just go for the last minutes to the end of the discuss about how you as a deputy or senior management if you want to develop a strategy for local currency funding, what will be the main takeaways to share with your teams when you will be back at home? So if you go, please, Konate, on slide 31, please. I will not talk about a lot of the benefit because we all know that it is a no-brainer that providing funding in the right currency is something we need to always provide to our borrowers. So one additional benefit I wanted to mention here when it comes to local currency for AADFI, of course, if you only do euros or dollars in your daily business, having local currency in addition of the funding you can provide to the borrowers may bring you potentially, but this is something you need to test, new potential clients who never discussed with you before because you are just providing euros, dollars. So you are just adding a new tool, in your different instruments you can work with your borrowers. And of course, you can still continue to promote a sustainable finance as an impact investor to provide the suitable financial solution to your client. And of course, there is a lot of advantages when it comes to local currency, just from a credit rating perspective or a risk management perspective. You borrow dollars, euros, but you can also borrow local currency. It's just helping you to diversify your funding, mixing your funding base. And usually it's well appreciated by the credit agencies, and especially for those who are running FX exposures because they have some mismatch as has been proposed and showed by Isabel during this survey. Some of DFIs have exposure in their balance sheet. If they close this exposure, thanks to TCX or any other hedge provider, it can be recognized by some external investors or external parties like rating agencies saying that the risk position have been closed or can be managed thanks to the hedging instrument that can be used by this DFI. And last but not least, using hedging solutions can also still be a good opportunity to promote the development of local financial markets. Just to take an example of the African Development Bank's program, where they help local issuers to go to local market to fund themselves in the right product. So that's why that had been proposed by Solomon Kenner on the credit enhancement solution can be a good one. We made some realization in the past, if I took the Kenyan market, for example, where the mortgage refinancing company is using bond into this market. Some investor, international one, are buying these bonds and hedge it with us. So tomorrow, if you intend to issue bond in your local market, you still rely on local investor, but you can also rely on international investor. Thanks to the hedging provider, we can, thanks to the hedge, we can facilitate to them. And of course, when you talk about debt capital market, it still can be associated to thematic bonds. It can be green bonds, climate bonds, social bonds, etc. And if I wanted to finish this presentation with the next slide on page 32, on, as I mentioned, on how you as a senior management can develop a strategy in local currency in-house. As a reminder, I showed two solutions, 1 and 2, where you can have access to funding in local currency directly. This is my golden way, KFW can. And the solution 2 is I still receive dollars from my lenders and I hedge it in the way on a tailor-made basis. And of course, proposing local currency always came with the dissemination of the culture of local currency at the different level of the banks, not only on top management, but also with the operation. When your team is looking for opportunities on the ground, is originating transaction, they will have a tool in the suitcase to the potential client they have in face saying that we can provide you your dollars to finance your activity. And of course, by doing this, you need for the operation teams, and also local currency that came with not only at the operation level, but also to the risk team. And if I just took the solution one, so you are just receiving funding in local currency, and you do not want to deal with derivative, or you think that it can be complicated to hedge directly for many reasons. Of course, you need the support and to embark the financial department mainly, CFOs, treasuries, but always with the support of risk officers. And of course, if you are already operating in local currency on the operational side, it is always already something that can be performed by your operational teams. And if it is the first time for you as an institution to go on local strategy, because in the past the operation have never provided loan in local currency to the borrowers. Of course, you need to focus on this side by including also the legal stuff, because concretely how it's worked in the loan documentation you will provide to your own client, you need to be sure that you can replicate all the provision you have on the hedging side. So the way it works, it's always simple. I contract a hedge, but I need to be sure that the provision I have within the hedging documentation are replicated on the loan side, not full, but some of them. So this needs some legal implication when it comes to loan documentation. And of course, the back office, because when it comes to offshore product, you need to be sure that the team can correctly manage all the flows, not only when you disburse the money, but also when you are collecting interest and principal repayment on that side. And last solution, which is the silver way, where you do whatever you want by having access directly to TCX as a hedge provider. As I mentioned in my example, you want just to hedge the principal or the interest. Before transacting derivative, of course, someone needs to be sure that the treasury team is sufficiently equipped to absorb this new task by absorbing, saying, transacting with hedge providers, making the settlement on time, and following all the requirements when it comes to the documentation. As I mentioned, before executing any derivative, there is one requirement, is to sign this master agreement, which we call ISDA. And of course, all these solutions and objective I mentioned here in terms of deploying this strategic aspect can be still supported thanks to the own budget of the DFI, but not only. And we at TCX, we have the capacity to support any of you if you want to go in this area by making, as I mentioned, trainings, dissemination, but also working with our shareholders, which are lenders, to provide technical assistance on that side. So on that note, I wanted to end here and let's hear from you if you have additional question or not. Thank you very much.
Thank you, Temba. I think it's been a very interesting session. This is just to whet your appetite. For a number of us, we already speaking to TCX and transactions are being executed. So I want to encourage you, if you have challenges in your portfolio, please engage them during the lunch hours and see how you can progress the discussion of hedging your exchange rate. But as I said earlier on, You can go beyond the exchange rate and begin to look at also your interest rates if you have a floating rate borrowing on your books. On that note, I want to say a big thank you to all of you for your questions, and also to TCX for bringing us a solution that will help cure the challenges on the balance sheet. Thank you very much.
Countries. I mean, Africa is replete with culture, and we want you to enjoy some of the cultural performances that we have here in Ghana before you go back. So just a quick 5 minutes interlude with that before we go for coffee break and then come for the next session. Thank you so much. Thank you so much. And that cultural interlude was the Northern Dance, I think from the Dagomes. And it's usually during the Fire Festival that they do those dances. I hope you were thoroughly entertained. I was expecting that they would come and do the translations and everything for you so that you can understand it better, but I can engage you on that further as far as Ghanaian culture is concerned. We have so much to share with you. And for those of you who stay for our final day for the trip to Cape Coast, you will enjoy some more of that. So this is just something, a teaser for you, just to tell you that welcome to Accra, Akwaba, and thank you all for coming. We're going to move into our next session now. And I'd like to introduce the moderator for that session. He is in the person of Mr. Solomon Asamoah, Chief Executive Officer, Ghana Infrastructure Investment Fund. He has over 25 years of experience in transactions and has led over $4 billion in transactions across the African continent. In his role as CEO of Ghana Infrastructure Investment Fund, he oversees origination, structuring, and investment into infrastructure-related projects across Ghana. Prior to his role, he held a number of notable positions, including Vice President of Infrastructure, Private Sector and Regional Integration at the African Development Bank, AFDB, Deputy CEO and Chief Investment Officer of the Africa Finance Corporation, AFC, Vice President of Private Sector and International Investments at the Development Bank of South Africa, DBSA, and Special Assistant to the CEO of International Finance Corporation, IFC, and Managing Director of the World Bank in Washington, D.C. He began his career as an investment banker in the City of London and has a master's degree in chemical engineering from Imperial College, London. Ladies and gentlemen, our moderator for this session, Mr. Solomon Asamoah. He will take us from there. Thank you.
Good morning, everybody. Can you hear me? Yes? Yes, good. Thank you. Very happy to be with you, and thank you for the organizers for inviting me to moderate this session. I thought we were going to have a coffee break, but it seems like we're moving straight in to the session. So I'd like to introduce my panelists. Okay. There's some new names here, so I'm not sure. So it's these four. Okay. All right. Okay, thank you. I'm good. All right. Okay, so let me introduce my panelists, and I'll ask them to join me on the panel, please. Firstly, Mr. Stephen Nelatambi, the Director, Financial Sector Development, Africa Development Bank. He's not here. I was looking for him. I used to work with him. He was my colleague. So very ably represented, but also my former colleague, David Ashiabo here. Thank you. Oh, yes. Please take a seat. So David is a financial sector specialist at the Africa Development Bank, and he's also been involved in the financial sector development strategy at the bank, and provides support to the whole of the organization on financial sector matters. Second on my panelists, I'd like to introduce to come up with Mr. Kaede Piton, MD, CEO of Bank of Industry, Nigeria. Round of applause, please. Thank you very much. The third panelist is Ms. Kampita Zogo, the CEO of Development Bank of Rwanda. Please, a round of applause for her, please. Thank you. And the final panelist, Idrissa Koulibaly, Director of Risk of National Investment Bank of Côte d'Ivoire. Thank you all. I won't be able to do them justice, so I'm going to allow them to introduce themselves and give a little bit of flavor of their background. But let me first set the context, really. As the discussions this morning touched upon, the importance of financial sector financing and innovative solutions to solve our development problems. Everybody knows that there's significant development challenges across the continent in Africa, and if we're going to be able to fix all those challenges, we need financing. We need to know innovative ways to address those issues, finding sources of financing that are both large enough and appropriate enough so they don't actually add to the problems by creating additional risk problems for the financing institutions. So with this excellent panel here, we will talk through some of the issues that they face in their work and some of the challenges and some of their solutions or proposed solutions for trying to overcome those challenges. And then we'll also leave a significant time for participation with the audience, questions and answers. We can see if we can move the agenda forward through this session. So I thank you for your attention. So let me first turn to you, David. Perhaps you could give a little bit of background about your role, what you're doing at the bank, and the areas and the challenges that you see that need to be addressed through innovative financing solutions.
Thank you very much, Solomon. And I'd like to thank AADFI for this opportunity and obviously offer an apology on behalf of my boss, Stefan Nelatambi, who couldn't be here for various reasons. So I sit in the financial sector department, and my title is Chief Financial Sector Strategy Officer. It's much grander than it sounds, which means that I'm responsible for leading the development of the bank's financial sector strategy and also looking at other strategies to the extent that they interact with the financial sector. I think for us at the bank, we really see the financial sector as a critical enabler of development. So our work in financial sector is not to have a strong financial sector for having a strong financial sector's sake. It is looking at what do we do to build a financial sector that is able to mobilize and allocate resources to the real sector to support the economic growth and development, the inclusive growth, the transition to green growth that we need on the continent. And for us, the African DFIs are a key part of that. We see, I think, as my VP, the other Solomon said, the other Solomon was saying this morning, we see a lot of complementarity between ourselves and the national DFIs. We think that the national DFIs have a national presence that we don't. We have it through country offices, but it's a different kind of presence. They are much more in tune with the local economic actors, particularly the SMEs, etc. They can do a lot more in terms of local currency funding than we can for various reasons. So our work with the DFIs really, I think, is moving to a stage where we are thinking, okay, we've been doing a lot with the African DFIs in terms of financing, using all our instruments through equity, through grants, through technical assistance, through guarantees and whatnot. So I think the thinking now is how do we move from being a simple financier to working to strengthen the African DFIs, because we feel that they're a critical missing link in the financial system. So that's what we're looking at. And I think I'll just stop there and give the other panelists a chance and we can come back and pick up some of the detail later. Thank you.
Thank you, David. Very good introduction and an overview. And we will be exploring one of the major aspects of this, which is how DFIs or international DFIs or African DFIs can better support local DFIs. And that we'd like to explore during this session. So thank you. So Mr. Kaido Pitan, can I turn to you, please? Please give the audience a little bit about your background, your institution, and the issues that you face in Nigeria. I lived and worked in Nigeria for 7 years, so I know your organization quite well before you headed it. But it'll be a good experience, and you've made some good strides in Nigeria that I think will be relevant to share with other members here.
Okay. Thank you very much. My name is Simon Aranono. I'm the Executive Director in charge of what we call large enterprises for Bank of Industry. I represent the Managing Director who is not available today. I would like to say that I'm sure the challenges we face in Nigeria, we are a very humble institution. I work for Bank of Industry is about 61 years old, and we have our own challenges, but somehow we have been able to find ways and means to be able to overcome some of them. We still have a long way to go. We are still learning. We like to learn from everyone else. But our key challenge, obviously, is one, we are not a deposit money bank. I'm sure most of us are, all of us here, we don't have a deposit money, we don't have a license to mobilize deposits locally. However, we could easily, float bonds in the local market and raise funds on long term to be able to finance our operations. But the key challenge we always face is where you have inflation running at a rate of maybe 12, 13, 14%, and then secondly, you have local interest rates, running at some 13, 14%, and here we are, we're lending money at below 10%. So if you're lending money at 9% as we do, the real challenge is which market can you be able to float bonds to be able to raise that kind of money? And that became the major challenge we had. And so that actually propelled us to realize that the only way we can be able to fund our operations is to raise money in markets where rates will be close to not more than maybe 4 or 5%, so that we can be able to lend at 9%. And so that drove us to the world market, the syndications market, the Eurobond market. We've been in all of them. And with all this sense of humility, we've made some good success in those areas. In the last 4 years or 5 years, we raised about $4 billion in both the Eurobond market and also in the market for syndications. The benefit of this is that you have low interest rates, and then you can afford to be able to lend within the banks for development that you want to achieve. And so that's how far we have been able to manage to overcome the challenge. But the next challenge, connected to that, is that because of local currency fluctuations, I listened to discussions on the hedging. It was very interesting. If you get Forex and you're going to lend in local currencies, you expose yourself to FX risk. And so we are bound to hedge. And I would say we have, again, with all the sense of humility, been successful in hedging, hedging using the Central Bank of Nigeria, who has given us 100% swap deals, take the currency from us, give us local currencies, and basically guarantee the availability of the dollars to repay the loans. This is the simple model we have used. As we go on later, I will discuss other challenges still connected to this process, which somehow we've also found some innovative ways to overcome. Thank you.
Thank you very much. And You've actually touched on a very important point, and it's something I think we will also talk a little bit more about, which is the role of support of the state behind you and what things the state can do, whether it be the central bank or the government, to support you in your operations. So I'm sure we'll explore that a little bit later. So Ms. Sayinzoga, I understand you may have to leave us shortly, but we'll take advantage of you while you are here. If you could kindly just give a brief introduction to yourself and the institution and some of the areas that you challenges that you face in Rwanda. Thank you.
Thank you very much, and thank you for having me here. My name is Kampeta Sayinzoga, and I'm the CEO of the Development Bank of Rwanda. We have only one development bank, unless many other countries, so that means if we do well, we do really well. If we do bad for everybody, so the pressure is on. But maybe speaking to some of the challenges, or maybe first, some of the nuts that we've managed to crack, and then some of the challenges that we're remaining with. We're also non-deposit taking, so we have similar issues as my neighbor here. One area that we've managed to crack, I would say, is to show value to our shareholder, which of course is government in our case, in being able to raise innovative concessional financing for development. And I'll give you one example. We've had a renewable energy project with one of the large international DFIs. And through this project, we've managed to raise a credit line for the solar companies. Now, the first thing that we faced was activating demand, because it's one thing for you to want to lend money to the solar companies. If the population cannot afford the solar system, there's no deal. So what we did was to work with this DFI and put in place a system where we could access grants through carbon trading. So for every panel that is installed, of course the population, it's very hard for the population to gain the credit, and even if they got the carbon trading credit, the amount would be so small that it would not make much of an impact. So we managed to consolidate the carbon trading, flip it into a grant, and through this grant give an end user subsidy for now create or activate the market for the solar companies. So that has been very successful. In the past 2 years, we've managed to connect over 100,000 households to the system. So we also managed to galvanize the local solar companies, because the other thing that often happens, I think it's a little bit the elephant in the room, when you have, some of these concessional lines, before you know, foreign companies are the ones that come, they are ready, they have appetite, they are ready to take risks, they often have a big backing from their headquarters, and our own African companies don't benefit enough from these credit lines. So this was quite successful in providing upfront financing for the local companies and giving a platform for the local companies to be able to thrive. Now, the last issue that we had was really around, even with the end user system, of course, there was a copay for the poorest households, and they couldn't pay the copay. So the 10% that was the copay that was supposed to be paid to the solar company was not coming through. So we went through a crowdfunding challenge, which is called Chana Challenge, which in my language, Chana means lighting up. And we used Twitter, actually, and Instagram to raise funding from the public to pay the copay on behalf of the 10% and on behalf of the poor households. So with that, it allowed us to have leverage and incentivize the solar companies to connect the poorest members of the community without distorting the market, because then the solar companies were paid the full cost. So there is a way that we can partner as development finance institution, because we are credible, because we are trusted, for the same reasons that have been mentioned from my Nigerian brother, that we're able to come to the public and also raise some funding from the public, match it with credit lines and with end user subsidy. And at the end of the day, we're able to show value to the shareholders and say, instead of you spending this money through the budget, if you give it to us, we can leverage money from the private sector, and we can even leverage money from the public. Now, just to end, I think one of the challenges that we faced, and we are making some headway, but we haven't cracked that nut yet, is really access to climate change financing. So after COP26, there's been a big push by a lot of our partners, especially our European partners, to say we want to see African private companies be part of the narrative and the conversation around climate change. But when you look at the institutional framework, it's really hard. I think apart from this good example that we've had with carbon trading, the rest is really, really tough. And in some cases, it's even distortionary, right? I think those of you that are involved in clean cooking, you've seen that carbon trading for clean cooking is so appetizing that they don't even have to sell the clean cooking stoves. They can make money just from claiming the carbon credit, which is distortionary for SMEs in Africa. So one of the things that we've done, and you'll see it in the pamphlet, is that we've decided to become GCF accredited as a development bank. It's really hard. We've been at it for a year, but we've used the money from ICR, one of the partners of this annual meeting. And ICR has given us grants to have consultants that look at our policies, look at all the things that we need to change in-house to become eligible. So 2 weeks ago, we managed to officially apply, and we're quite confident that it should go to the board this year. And this is one of the ways that we're hoping to kind of cut through the queue and cut the lead time to have access to sizable concessional financing. But we can tell that building the pipeline at home is going to be a challenge. When you look at what constitutes a green project, yes, we do have them, but the scale that we'd like to have will require a lot of capacity building. I thank you.
Okay, thank you. Thank you very much for that. So many areas that we can explore. But I just wanted to ask you one general question. What would you say are the biggest challenges that you face as your institution in terms of having the impact but retaining commercial sustainability and relevance? What are some of the biggest challenges that you have to face?
So in the past, I think like many development banks, we've had a history of success and failures. So my institution, BRD, went through a very tough time in 2016. And I think two challenges emerged. One was the risk management framework was quite weak. So a lot of project was passing through without proper due diligence, and the corporate governance system was a little bit weak. So that was, I would say, one of the large lessons. And speaking to that, I think many projects that should have been de-risked by the budget, to be honest, were pushed through under the window dressing of being private projects. And we've had a couple of those in the past, and I'm sure many of my colleagues will have faced that. You know, you get a project, it's not really commercially viable, so they send it to you as a development bank, but there's no real backing to cover the non-commercial parts. But we've learned from that, and I say, in all humility, I think our government has also learned from that it doesn't work, and in the end, you end up with a weak development bank. The second one has really been around, 2 years ago, we had and to answer your question about how do you achieve financial sustainability, I think one thing that has helped us a lot is really the wholesale lending. Because if you have a stable financial sector, and you're able to develop products that are attractive to the commercial bank, but in areas that are priority for your government. So in our case, for example, we have this renewable energy product, we have an affordable housing product, we have an export growth product. And these, we can lend directly if we'd like as a bank, but the main target of these products are the commercial banks. So if you're able to figure out that spread that is not too juicy, but juicy enough for the commercial banks to speak to you, then it means that in our case, we've moved from 2% of our portfolio of wholesale by 2019. Today, we're at 25%. And the target we've agreed with our board is that by end of the year, we should be at 40%. Now, that cushions your NPL and safeguards, at least gives you a safe and sustainable income flow. And it improves your net interest margin and gives you a bit of headroom to be a little bit more a little bit more risky, take a little bit more bets on your direct lending window. So I think achieving the right balance, and different banks and different countries have different appetites, but between the whole lending portfolio and the direct lending portfolio can create some headroom and keep you within good ratios.
Okay. Thank you very much. Thank you. Interesting. And this wholesale model for national DFIs is something that I think is taking a lot more attention is being driven to it. We have recently set up in Ghana, the new Development Bank of Ghana. Similarly in Nigeria, Development Bank of Nigeria, I think African Development Bank has been involved in both. And the idea is to try and learn from some of the lessons of the failures of the past and try and move more to a wholesale model where you can, as you say, diversify the risks a lot better. Thank you very much. Mr. Koulibaly, if if I can turn to you, please. If you could briefly introduce yourself, your institution, and just give us an insight into your institution and some of the issues that you are facing.
Thank you. First of all, I would like to say that we are very, very glad to be here in Ghana, and we want to greet again, thank you to the AADFI President and General Secretary for inviting us and all our colleagues. I'm Idrissa Coulibaly, Chief Risk Officer of National Investment Bank. My MD is apologized, can be Yusuf Fadiga, because of you have some other activity in this program for today. On National Investment Bank, we have two roles. We are developments, but we are also facing the competition of commercial banks. So this is not easy in our market in West Africa. In Ivory Coast, we have around 29 financial institutions. And National Investment Bank on Ivory Coast, we have ranking as the 6th position. So we win 2 positions in less than 2 years. This was a very, very good challenge for us. So to come with a topic about innovative solution for financing developments, we can say we have a digitalization of our products and our process, because we have the issue of the time to access to credit. So one of the big issue is the access to credit for informal sectors, but the time to the approval of the credit and access to the fund. So we face this first challenge. One of the solutions is the digitalization of our process and products. The second one, my colleague from Rwanda talked about the climate risk challenge. So we know in our environments of regulation, climate risk is one of the main issues. So we are going to a green certification in our institution, so to allow us to have the opportunity to have the chance to mobilize another type of resource. And this is for the 2 points I want to highlight before going forward.
Thank you. Thank you very much for that. I actually just realized that I actually didn't talk about the institution that I actually work for, which is actually very relevant to this discussion. So very quickly, I'm the CEO of the Ghana Infrastructure Investment Fund, which is a government-owned investment vehicle based here in Ghana, capitalized by the government. We are at about 325 million US dollar size capital all paid in. And our mandate is to invest and develop in infrastructure assets across Ghana. And we've been quite busy in the last 4 or 5 years. We have a portfolio of 13 infrastructure investments, which we put a combination of equity and debt in. But the key fact is that for every $1 that we put in any of our investments, we've managed to raise $10 from other sources. So in total, for the $300 million that we've invested so far, when the projects are completed, there will be over $3 billion worth of investments into Ghana infrastructure. We managed to do this by being very close and being very keen about what financiers like to finance and what they don't like to finance, and try and structure our investments which meets their criteria. Now, the challenges that we face is the same. Funding, very strong role by the government, in our case 100% owned, which I see as a positive. But there are some things that government wants you to do which don't necessarily are in the best financial interests of the institution. How do you balance that? How do you walk that line between working closely with your government but being aligned with their strategic priorities and keeping the financial sustainable institution underneath you? So I'm in the same boat with all of you to a certain extent, so we can discuss these issues more freely. So I wanted to actually just have another round of questions, specifically on this issue of state support, government support, government role, where is the line? How do you manage your relationship with your national governments? And then are there any lessons that you've learned to allow you to actually have a very fruitful and stronger relationship with your national government and avoid the downside parts? So I'll ask anybody who wants to speak first about the relationship with their government.
Yes, we have the chance to have the 100% of support from our government, because when you look at in our capital, the shareholders is the Republic of Côte d'Ivoire, so we don't have any problem of support. And to go further, we know that when we face the issue of the pandemic, the government has helped the National Investment Bank with some decision and some action point to mitigate risk inside some clients who was facing some trouble because of the activity. So we have an excellent relation with the government of Republic of Côte d'Ivoire, and we have some performance contracts between the Ministry of Finance. So every years we are performing some indicators we have put in place, we are following, and we had the chance to be awards. We have won the prize of one of the performer, the first performer enterprise, national enterprise within the government. So we have an excellent relation with them.
Okay, thank you. Do you receive, or anybody else want to make a comment? I'd also like to understand if any of you continually receive funding from your government, or you expected to raise funding yourself?
We receive as funding from the governments, but the bank have initiated since 2 years ago the diversification of the funding. So we have created a new department of treasury, for instance, in line with the presentation on FX, to try to diversify the funding. We are working with some development bank like AFD, IFC for green financing, so funding. So that's on process. The top management intend to diversificate. It's also for regulation purpose, because as we know, the presidential guideline for the ratio, when you want to avoid to have the concentration on one actors, you need to find some diversification, so you will not be able to have the chance to finance several clients and customers.
Anybody else? Yes.
I really want to mention that the fact that he who pays the piper detects the tune. But one thing that I'm sure all of us are facing is, how do you manage your shareholder? Your shareholder will be able to will write the rules. But I can share interesting experience that we've had with our government. It's an amazing, wonderful experience. And what was the first thing is, we are all Africans, and we know that there will be political pressure everywhere. You know, the shareholders, that's government, we want to be able to, present projects that they believe you should be able to finance. We all face that pressure. But we somehow, I would say we are privileged with all the sense of humility. One, we are insulated from political pressure. And that you must do if you must succeed. And if you don't want to have an MPL that will make you unattractive to any foreign lender, you must be insulated from government. Instead, you should use leverage on state to be able to enhance your credibility, to be able to raise money. And that's somehow what we have been able to do successfully. How are we insulated from government? The truth, the starting point is management. And basically every one of us At the top, we are hired from the private sector. So we bring in private sector philosophy into a public institution. And that's one. We all have contracts. And the next thing is who is supervising you. You know, we have, I would say, the ministers supervising us are people who are also professionals, also from the private sector. And so they give us a lot of support. They help us to insulate us from the lending process, you know, so that we can do professional lending based on our analysis. Of course, connected to that is the fact that, you know, our lending model is such that, you know, we do wholesale lending. And the wholesale lending, basically, we take guarantees from commercial banks. And in return, you know, release monies ultimately to the users through the commercial banks. With this, it's literally impossible for any state operator to be able to influence the lending process. Because you need to have an NPL ratio, a high quality risk asset portfolio that will enable you to go outside your country and raise money. And you must therefore be insulated from political pressure. If you achieve that, you are good to go, you know. But then on the positive side, we have now leverage on the same government to be able to get sovereign guarantees. We leverage on the same government to get guarantees from the central bank. But the secret is keep your risk asset quality very high. Every year on the average, we make $100 million. This year we made $150 million. And government expects revenue from us. They budget for in their own budget, they make provision for dividends from Bank of Industry. Just last week, we paid over $100 million to them. So that, with that kind of performance, they are comfortable. They don't give us subvention, but they give us the sovereign backing to enable us go raise money. Then the institution of the state through the central bank will provide the swap arrangement to enable you to hedge against the currency fluctuation, and then you are good to go. This is our own experience. Have we been able to get to where we want to get to? We are far away from where we want to get to, you know, but I think it's a humble beginning, and I believe we can still learn from others. Thank you.
Thank you.
I just wanted to add something, and I fully agree with him. The quality of the management, the quality of the portfolio, the arm's length situation. I wanted to add one point, which is the composition of your board. Because if you have an independent board chair, and you have people from the private sector or technocrats as members of your board, it is fundamentally different from having politicians or politically exposed people, let's put it mildly. Because sometimes it's not the politicians, it's the politically exposed people who are more critical than the politicians. So I think it's important to have an honest discussion with your ministers and agree on the composition of the boards and who appoints the management team. And by management, I mean the executive committee. Of course, there will be an appointment process for the CEO, but often you find, as my brother has said, if your management team is not recruited by the CEO based on merit, you're in for trouble. You're in for trouble. And that's one thing that has worked very well. One of the lessons that we've learned from our previous failures was to say we need to have a technocratic institution. Now, the next point is also, for us, was having the central bank regulators. And I know it's a sticky point with development banks. But in our case, it has actually helped even me as a CEO to be regulated, to make some of the points across around, you know, the need for discipline and the need for abiding to the rules and just generally doing what is right for the long term. So central bank regulation can be seen as a straitjacket, but I think if you have a good conversation with your governor and with the team, it can actually help you make sure that you have discipline within your own bank. So for us, it has worked positively.
Okay, good. Thank you very much. If I can just ask one more general question before then we will go to the audience to ask any questions. We talked about the relationship with the governments. How about the relationship with the DFIs, stroke, financing institutions, banks more generally, commercial whatever. How have you managed those relationships in your institutions? And any lessons that you've learned that you can pass on those?
I think one thing that maybe I'll start, we've managed to raise last year around $380 million from the DFIs. If you treat the DFIs as a special project, as many institutions have done, they can override the main bank, if I can put it like this. What we have done is, yes, to have a team that's in charge of the relationship management, because some of them, and I won't name them, but you know them, can be quite time intensive. But making sure that the business teams are not derailed. The targets that you give them include some of the targets that you would have agreed with the DFIs, if it is an earmarked fund. If it's not an earmarked fund, then you generally have no problem. But having, for those earmarked funds, especially around climate, around, for us, affordable housing, having those embedded in the KPI and the balance scorecard of our team has been very helpful in making sure that we don't get derailed. The second thing is really around reporting, and having a team that's dedicated to reporting to them, making sure you report on time, making sure that you deal with the covenant in a way that's serious. Also gives a sense of credibility and trust, and for us, that has worked quite well. We've tried to make sure that we have a direct contact and we don't have to go through the Ministry of Finance to deepen that relationship, and it has worked well.
Yes, I will insist on the governance again. The governance, as my colleague told, we in National Investment Bank of Ivory Coast, in 2 years, we have divided by 3 the rate of non-performing loan because of the structure of the governance and putting the right people on the right place. This was very, very, very important for. The second thing is the quality of the reporting, as she told, to be sure that we send the good reporting to the right people. And last but not least is the independence, as she told, to comply with the regulation. So in WIMO, we have the same regulation for all the PFIs, even if you are commercial bank or you are, this can make some issue, because we say that we need to have on the board some independent administrator. As we know, when you depend on the PFI, the notion of independent is not easy. So this is one of the challenges also we're trying to face.
Thank you. You okay? Okay. So, Mr. Oh, go ahead.
Yeah, I just want to speak about the issue of a relationship between commercial banks and DFIs. We all, I'm sure we all face it everywhere in Africa. Whether you like it or not, we are all competing for literally the same business. And, so if you're a DFI, you just have to differentiate yourself. That's the secret. You have to offer what commercial banks can offer, because the deal flows, the same market, we are on the same market. We are doing infrastructure, we are financing in industries. If you are doing solar, someone is doing solar, but how do you differentiate yourself? Because there's a competition, the same customers. Everybody wants to make money. We are not into making money, but commercial banks may not be they may not listen to you on that, because they want to make money. So what we have done is we've tried to differentiate ourselves. How do we do that? On two platforms, two axes. One, in pricing. As I did speak earlier at the very beginning, you must make yourself clearly different from commercial banks. You can't offer the kind of rest they offer. Otherwise, you can't be able to get the deep flows you want. So when they are doing 13%, 12%, 14% lending, and I'm doing 5%, 7%, it's clear, very clearly, that even the customers will say, oh, I want to deal with Bank of Industry. Why don't you guarantee me so they can pass the funds to you? The second issue has to do with tenor. We all know commercial banks have short-term liquidity, and they can only lend money for short periods. Maximum 2, 3, 4 years. But we have the capacity to do 7 years. Because we're doing project financing, and in some cases we've done 8 years. And so with this, it's very clear that you can comfortably compete, so to speak, or create a niche for yourself that will enable the commercial banks to be able to, guarantee you, to enable you, so that the customers themselves will say, oh, guarantee us. We need to get money from Bank of Industry because the values they offer, you can't offer them. I think this is really the way to go.
Thank you. So, Mr. Africa Development Bank, how do you define the relationships that you have with the national DFIs, and what do you see as the major advantages that your organization can provide to them? And are there any areas that you would like the national DFIs to do a little bit more or less?
Thank you. That's a good question. I mean, I think we, as I've said, we see the national development banks as key partners. I think we're all focused around the same things. We've talked about climate, we've talked about affordable housing, we've talked about infrastructure. We fully support everything that has been said about governance and the importance of governance. And I think we think about governance in the broader sense. It's not just about who sits on your board, it's about your risk management, tools and procedures. It's about your reporting, because that really, if you're in this development business, it's your reporting and the results you're achieving that drives everything. And so we think it is critical that we strengthen the national DFIs in terms of governance, in terms of financial sustainability, everything, which links to the theme of this whole conference, which is around innovative finance. And I think one thing that really hasn't been explored enough and that we would like to see more of is working with national DFIs to raise long-term local currency in domestic markets. I think in Africa we tend to sort of default to talking to the DFIs, as in the multilaterals, people like us, or the KFWs, or the AFDs, or raising money offshore. So that's an area that we're keen to explore. We're keen to work together on helping strengthen governance. We're putting together what we call an Africa Financial Sector Corporate Governance Initiative that will really look at what supports the national DFIs need to strengthen their governance across the board, like I said before, and how we can do that. We're looking at leveraging our full suite of instruments, maybe in ways that we haven't fully done before. I mean, we've done a lot of the credit lines. We've got equity investments, but it's about how do we move people up the chain, so to speak, because realistically in Africa today you have some DFIs which can and are already tapping markets both locally and internationally. The question is, long term, do we want to continue giving these people credit lines, or do we want to help them graduate to private sector / market-based funding, and what help, and then focus our scarce resources on maybe the second and third tier national DFIs to build them up so that they can then start accessing private markets and achieve, leverage rates close to what you are achieving at the Ghana Infrastructure Fund. So that's sort of at a very high level what we're thinking.
Okay. We still want cheap money though.
Everyone knows cheating.
I know. Okay. So if there's anybody in the audience who would like to ask a question or make a comment, now is a good time. I think we'll be wrapping up in about 5 minutes or so. So if there's any questions or comments, I see somebody coming to me in the corner of my eye. So speak now or forever hold your peace. Here's your chance.
Thank you very much. I'm a bit fascinated about Madam's comment about the need for central bank supervision. It's difficult to give up your freedom when the act says you shouldn't be supervised by the central bank, the BSD people, and then you give up that freedom. But this is the second time I'm hearing this. I think we met the CEO of the Uganda Development Bank, and then she also said to be able to parry off the political influence and so on and so forth, and to also be credible to international partners, they've gone for a modicum of central bank supervision. I would like to, if you can engage a little bit on that. To what extent is it, because if you give the central bank, I know they are here, so I'm a bit careful. If you give them unfettered access, you will lose that leverage of a development bank. So to what extent do you give them access so that you don't become another commercial bank? I don't know if you get my. And then the second bit about reporting. Do you also, we are a development bank, but we have some funding from the international finance, international financial markets, and they chase us for our audited financials, but the Auditor General has to appoint an auditor for us, and you know how difficult that can. So how do you appoint your own auditors, or is it the Auditor General that has to appoint auditors for you? And if so, how are you able to do that and then do it very quickly? Thank you very much.
Thank you. Let me take a couple of questions and then we'll, if anybody else has a question. There's a hand over there.
Well, I got...
Sorry, could you introduce yourself and your organization, please?
Okay. My name is Nkaren Litsia. I'm from the LNDC, Lesotho National Development Corporation. I heard you very well when talking about governance and the appointment of directors. How easy is it for the government institution to divorce the political appointment to the directors and try to make it as professional as possible? And second of all, how easy is it to have the tenure of office that is divorced from the political change that happened in the country? It's because this is what we have been juggling with in Lesotho.
Thank you for that. There's a question here. You have the mic, please? You have the mic? Go ahead.
Thank you very much. I think it's more of a challenge to FDB, because I think FDB is one of the biggest players in Africa in terms of the military institution. The challenge is that most institutions are not getting the privilege or benefits from AFDB, and that has really kind of constrained some national DFIs and regional DFIs. Is there a way that AFDB can kind of strengthen that collaboration, maybe probably through AADFI or individually? Because again, in my 2 years of being in DFI, I've seen that most institutions are looking out to outside the country for fund, where we can easily get those kind of funding in Africa. Because the question becomes, the person trying to fund you, like, why am I trying to fund you when you can also get that same funding in Africa? And AFD had the same privilege. As somebody talked about the SDR, for example, how can they help? Because these are babies in the system, and they need all the support that they can get. So I want to challenge AFDB. I don't know what they are doing, but I think they need to strengthen that collaboration with DFIs that can help them to help them, because they are the local player in the system more than they are the lower rung, so they understand the market more, and they can help in trying to develop the, try to move development that we are talking about. So I think I need to challenge African Development Bank on how they can help. Thank you.
Okay, but I just want to challenge you. Can you say one or two specific things that you would like to see them do more or better?
I think, first of all, equity investment is one of them. I mean, it can be equity investment. 2, line of credits that can help, because we're talking about climate funding today. They can help with not only the investment, they can also help with helping to grow the resources of those, them to understand how to approach climate funding. So those are also key things they can do. They have resources, they have knowledge, and most of the financial never don't have the same resources exposure, so they can bring experts, partner with those institutions to help them develop their systems. Okay. Thank you.
Thank you. I'll give them, obviously, a chance to respond. So let's get some responses to some of these questions. So the first one was related to central bank supervision, good or bad, and how do you manage that, that line? Because I think you said it's been good for you to have central bank supervision. I think many other DFIs wouldn't necessarily want to go down the same path, but it's good to hear your experiences.
No, thank you very much. I believe in life you need to choose your poison. So either way, somebody is going to supervise you. You can't be using public funds and think no one is going to supervise you. So if the central bank is not supervising you, somebody else is supervising you. Yeah, are you sure that this other person that's supervising you is more competent in understanding financial sector issues than the governor of the central bank? Should be the central question, right? And I agree with Patricia, if she's mentioned it in another meeting. Many times we've managed to fend off, political pressure by saying, I can't do it because the central bank regulation does not allow me to do this. And in our political environments, typically, I think our governors of central banks are heavyweights. You rarely have somebody who's politically weak as a governor of the central bank. So it's an additional voice to fend off some of these pressures. Now, one thing that I would like to add, though, is in committing to compliance to the central bank regulation, you must also open a door to have a special regulation for you as a development bank. And that has to be a continuous dialogue, right? So I'll give you an example. For example, in our own central bank regulation, in the regulations of the central bank, there's a special chapter on development finance institution. Well, we're the only one, so we know it's for us, but if you're many, you can apply it to many. Around, for example, the number of restructuring during grace period, because you will need more restructuring, the number of restructurings after the grace period, your net open position, because you're more open to foreign exchange, to FX risk. We've also benefited from a swap from the central bank, as it is in Nigeria. So we've had this conversation. Sometimes, you make the case, right now I'm making the case for a slightly higher NPL, ratio compared to the commercial banks. I'm not winning that argument, but I'm hopeful that at some point they'll hear me a little bit louder. So it's not that every argument that you make is listened to, but you must secure, if you go that route of central bank regulation, you must secure a special regime for development finance institution. And every supervision mission or every prudential meetings is an opportunity for me to lobby for a little bit more, wiggle room with the governor. And in exchange, I try also to be a good girl and make sure that I comply with as many as possible as is regulation. Now, that is related, by the way, to your second question around the Auditor General versus your own auditors. Because we are registered under the banking law and we're supervised by the central bank, we are not subject to the Auditor General's regulations, because you can't be part of two systems, right? So by moving to one system, I should say it very, I hope it's not going to be reported, but we freed ourselves
You're
from
amongst
the Auditor
friends.
General.
You're amongst friends.
I hope so. But by moving to the, that's why I say you'll always have somebody in your soup. You just need to decide who's going to be in your soup. In introducing the governor in my soup, I managed to release myself from the Auditor General, right? So it also gives you more leeway to do some transaction, and typically the central bank will understand if you've taken on some reasonably well assessed in terms of risk assets, which the Auditor General may not understand because he's looking at it through the eye of the public budget where you should lose no money, right? So I think you need to choose who. It's true. You'll never see an Auditor General that tells you it's okay to lose 4% of your portfolio, right? So every loss will be a headline. But with the central bank governor, he understands that if your portfolio is, you know, $100 million, you're going to lose some. You're going to make some, you're going to lose some. So there's some sub-layers to this discussion, but we can discuss it better. I wanted to talk about the ADB role, if I can, before I leave, unfortunately. Because yesterday, VP Solomon asked me to stand up. I had a very candid conversation with him, and I had to kind of remind him that the reason why, and I'm very glad that I think most of our governments are now serious about supporting development banks. We're in a place where the new generation of interventions are serious. African governments are taking their development banks very seriously. And I think the risk of us, completely collapsing now is quite low, because if you look at the caliber of people who are in the room, it's not the same caliber as in the 90s. These are real bankers, real private sector people. And I was telling him the reason why governments put equity into the development banks is for exactly two reasons, which have been mentioned by my Nigerian brother. It is better tenor, access to long-term capital, and lower pricing, right? So whatever the FDB is doing in conversations with DFIs, that has to be a case in point, right? So if I have 6 lenders and the FDB is the third most expensive lender on my list, it's a problem. There's a problem of relevance, right? And I think very often we think that, development finance institutions are looking at quantum of money. But the truth of the matter is the reason why the ministries of finance put money in us is not really the quantum, it's the pricing. They want to see a different pricing on the market. So if we're not able to align on this, it's going to be very difficult. The second thing which I managed to discuss with Solomon was really around the turnaround time. Like, I can't build a pipeline and I close a deal with the African Development Bank after 3 years. Like, it doesn't work. So the turnaround time is a problem. And sometimes because of your liquidity requirements, you turn to a lender that's maybe slightly more expensive or has less, but you know that this lender is going to be flexible, and you know that you're going to be able to sign a term sheet in, X amount of time. So I think as our development finance institutions become more serious, more business-oriented, more aggressive on the market, more responsive to wholesale lending with the commercial banks, we can't take 3 years to negotiate a credit line, or 2 years. It can't work. So I think that was my key message, and he was teasing me yesterday, but those were my 2 messages to FDB, to say, one, your pricing is off, and we don't see how we're benefiting from your AAA right now as development finance institutions, and 2, your turnaround time is problematic.
Thank you. I had the same conversation with him as well.
Oh, really? Great.
Because we're about to sign our line of credit from the African Development Bank 3 years after we started.
So it's a problem.
Yeah, so it's the same story. Yeah, so, okay. Please, sorry, speak into the microphones, please, when you're speaking.
Okay. Just going to add a little to what my sister from Rwanda said, Development Bank. This issue of regulation, governance, supervision, it's in your interest to be over-supervised. Okay? At the risk, I hope that's good English. The more transparent your processes are, the more supervised you are, the more you are likely to come out clean. And the more you are likely to have a good portfolio, the more you are likely to become credible, to be able to get money from all over the world. In Nigeria, I said our bank is 60 years old. That's a secret behind its success. We are the most regulated bank in Nigeria. And I dare say that without any fear of contradiction. Why? We are regulated by the Central Bank of Nigeria, supervised. They sit inside our office for 4 weeks every year, like any other bank. Number two, we have our independent auditor, KPMG, that audits us like any other institution. Number three, we are also audited by the Auditor General of the Federation, because we're a public institution. Number four, the members of parliament, there are committees in the Senate, committees on banking, committees on, committees on finance. They come for what they call oversight function. Now, so we have and in addition to all this, we are rated by Fitch. By the grace of God, we are AAA, local rating. We are rated by Moody's. So if you subject yourself to all kinds of regulation, you can sleep better. You can sleep better. You need to sleep well. As long as you know you are transparent, you disclose everything, you can sleep well. I want to sleep well. Don't you want to sleep well? I want to sleep well. I have a background from JP Morgan Chase. I can't trade it off for anything. My CEO has a background from Citibank. We can't trade it off for anything. And we tell the people that, look, if you don't want to do this job the way you want we should do it, we are willing to leave. Get ready to stick out your neck for the truth. The more transparent you are, the more your institution can be sustainable. The more you have a better rating, higher quality risk assets, the more you can attract funding. Thank you.
Thank you, thank you.
And it's also related to the question by our colleague from Lesotho. Because if you're regulated,
yes.
If you have clear expectations in terms of profit, which reflects financial sustainability, your asset growth, then it's difficult for a Minister of Finance to just change MDs every time you have a change of Minister of Finance. So there's a correlation between the two. Because if he can't pick up the phone and tell you to pick up a loan, then the incentive to change you is slightly lower as well.
Thank you. You want to make a comment?
Yes, as I told before, for instance, in Ivory Coast, we have a performance contract between the Ministry of Finance and National Bank of Investment. So we are transparent, everything is clear, and the auditor also came to perform all these indicators. This is the first thing. The second one is the regulation. The Basel 1, 2, and 3, we have 3 pillars. One of the pillars is the transparency between the markets, and we know that in our market we have not only the PFI, we have a commercial bank, so we need to be transparent and to share all this information, so we don't have a choice about transparency. Thank you.
Okay, thank you. And I think we've run out of time, although I'm thoroughly enjoying the conversation. So let me first of all ask you to give a very warm round of applause to our panelists. And once again, let me thank the organizers for inviting us here. It's been a very good experience. Thank you very much.
Thank you so much, Mr. Solomon Asamoah, MD, Ghana Infrastructure Investment Fund. That was a wonderful session there. Thankfully, the time regulator is here, and I'm regulating my part of it so that we'll all move on smoothly. I'd like to call on Madam Patricia Ojang Gole, First Vice Chairperson, AADFI and MD Uganda Development Bank to give us her closing remarks. Thank you, ma'am.
Thank you. I'm going to be very brief. I don't want to stand in the way of your lunch. Our chairman, Tabo, Tamani, our host, Samuel Sapong, CEOs and MDs of DFIs, and our members, ladies and gentlemen, distinguished delegates. Thank you all for making time. I think you could see that we've just been cut short by the time, owing to the very importance of the conversations that we have had today. Our discussions centered on burning issues at the heart of the success of DFIs, and especially national DFIs. And I'm very happy to see the level of interest. It really shows commitment that we all have to see that we can create the much needed difference in our countries. The sustainability of our businesses lies in availability and quality of funding as one of the imperatives. And of course, we are discussing that we need to do things differently. The traditional funding approaches have not delivered, and therefore we need to innovate. My own experience is, I think there is funding, at least from where I sit. There is a lot of domestic capital. Our banks are sitting with a lot of liquidity. So how can we innovatively get that liquidity out of the reserves and where it is to kind of finance development? Now that is domestic. But also, in terms of foreign funding, there is a lot. Again, from where I sit, we have lots of people coming to see it and say they want projects, they have so much funding, they're looking for how to channel funding. So it goes back to really help us to see how best we can position ourselves so that we can mobilize funding from all sources. And for us to do that, it's a lot of work. And I think we need to be looking at the demand side issues of access to capital or unlocking capital, as well as the supply side. Ladies and gentlemen, our conversations again have set the tone for what we are going to be busy discussing tomorrow at what we have called the retreat of CEOs, and I hope we'll all be present tomorrow, because we're going to be having practical cases of all the things that we have talked about and the things that we keep on talking about. But also, how can we really turn around, change? What are the specific innovative financing models that we are currently looking to add in addition to the ones that we are currently undertaking in our own spaces, as you have noted. On this note also, let me thank all our guest speakers who have joined us today since we started in the morning, and our session chairs for both sessions, Mr. Steve and Mr. Solomon. I want to acknowledge the panelists for sharing your very great experiences. I'm sure you could see from the generation of discussions that there is a lot to learn. And I think our panelists are still around, so feel free to engage them. I also would like to engage them on some specific issues that I have had. So please take advantage of their presence, and anyone else who you believe can kind of share any knowledge or experience. I appreciate our host, again, the Managing Director of NIB, for making this possible, and of course everyone else, the translators, the IT team, and everyone for contributing to the fruitful deliberations in this annual workshop so far. Ladies and gentlemen, with that, I again take the opportunity to invite you for the afternoon session, where we'll be having the annual General Assembly. And with that, I beg to submit and hand back over. I don't know if you have any other announcements for the members. Thank you.
Thank you so much, Madam. I'm sure you would all agree with me that we have had a wonderful session so far. We're going to break for lunch, and then we convene after lunch at 2:30. Lunch will be at the Labadi Suite, which is next to the main reception. So if you make your way out, people will direct you. But if you know your way, go to the main reception and to your left where the ATM is, there's a room there where we'll be having our lunch. We will reconvene, like I said, at 2:30 and for our ordinary General Assembly. Before we go, however, we have a good outro for you to jam up before you go and eat lunch. It is called the Palongo dance. It is the land of the soil on which you are right now, the Ga people. And it's usually for the fisher folks when they go and have a wonderful catch and come back. When they get to the shore, the women meet them with a dance. And Palongo is just the nature in which the net actually flows and the canoe goes from left to right. So you would experience that in this dance. So that is our outro. So we'll see you when you come back from lunch. Thank you so much, and bon appetit to everyone.
Wuya, wuya, man, say,